Good morning, and thanks very much. First of all, brief apologies. So Gary Chan, the CIO of Phoenix, was due to be giving this presentation today. Sadly, he's got some personal matters, so I've been pulled off the bench to give the presentation today. So first of all, I'd like to just give a brief overview of Phoenix, who are the managers of the Aurora Investment Trust. So it was founded in 1998 by Gary Chan. It's grown organically over the years. We've now got 13 investment professionals, so analysts. I'm one of those. And the broader company has 31 employees across different functions. In total, the AUM is 1.6 billion, around that mark, 200 million of which is the Aurora Investment Trust. And then we have other accounts which are managed with a very similar philosophy and pretty much the same holdings as Aurora's managed with. So that's the Phoenix UK Fund, which is the original fund, and then various segregated accounts that are managed along the same lines. We then have a Hugin Fund, which is managed by one of the team, the same framework as Phoenix, but an international remit. We also have Castleknoll Group, so that's a listed fund in itself, and that is a combination really of the controlling and less liquid positions that Phoenix have been involved in are in that Castleknoll entity, and it's separately listed. And then more recently, Iona Star has come under the Phoenix umbrella. They're a smaller fund investing in sort of the AI software space, but they operate very independently from the investment team at Phoenix, but they are under the same umbrella. In terms of track record, I'll present some figures for Aurora first. So we took over management of Aurora in 2016, at which point it had a AUM of about 15 million. As I mentioned, that's now grown to 200 million. And this is the track record since we took over management of Aurora. But whenever we're looking at companies, for example, we want to go back at least 20 years to look at how they perform. So I mentioned Aurora's managed in a very similar way to the Phoenix UK Fund, which was the original fund. And these are the returns of the Phoenix UK Fund since it started in 1998. So we can see over that time, the gross returns have been 11.2% annualized. The NAV return, so net, is 8.7%. And that's versus the all-share index over that time, which is 5.2%. So we think a strong foundation and track record we've got using our investment framework. So why do we think we can generate those returns over such a long period of time? And there are a few different reasons. One of them is the depth and thoroughness we go through as analysts and investment professionals. And really that culminates in our obsession with the customer. And that's the customer of the business that we're looking at. So we really want to understand, why does a customer buy from a certain business? And typically for us, that's probably B2C businesses, but also it can be B2B. But we want to really know why a customer buys from a business. That gives us a great insight, and we go to a lot of work to do that. For example, Wetherspoons, visiting the pubs, looking how clean the toilets are, Sports Direct, visiting lots of their shops, all the new ones, why are consumers buying from them versus elsewhere. We also go to real lengths to reduce human biases. So we think we're aware of most of the biases that we could have as investors, and we put in processes to mitigate those. A really good example is every sort of 2 years, we do for a company a thing called a devil's advocate. So two members of the analyst team who cover a stock will take alter egos. So one's ultra bull, one's ultra bear, and they present on a company using the same data. They'll then debate between each other, and then as a team we'll have a discussion. And that's really fully designed to avoid endowment bias. So it tears apart in both ways our existing investments, so we don't become over sort of in love with them. And that's an example of what we do to reduce human biases. We've also been using the same framework for 25 plus years, and that's got the track record I showed earlier. And the framework's been very similar throughout. We do over time try and modify it. For example, recently we added environmental and social factors. We think they're becoming increasingly important. So they were added into our DREAM framework, which is how we assess companies. That's broadly been the same over the 25-year periods, with the occasional tweak to modelize it, but the core is the same. We also focus on specific stocks, and I mentioned customers earlier. So we really focus on companies where we can understand the customer. And there are some companies we start looking at and we just think we could never actually understand the customer. We could never get insight into the purchase decision. So they're not really the sort of companies we look at. So it typically is B2C companies and retail type companies we end up investing in, but not always. And finally, we try and learn through feedback. And here there's an interesting correlation with the best companies that we invest in. For example, Wetherspoons are unbelievably good at getting ideas from the people who know the business best, and that's the people running their pubs and the staff in the pubs, getting those ideas. And Currys are a good example in their restaurants. That idea came from one of the staff in the restaurant. It goes to the top of the company, gets fed back and changes the process. So you get this feedback cycle. We try and do the exact same within the analyst team at Phoenix. So we try and learn what we're doing wrong, make an improvement and a change. And an example of that probably is over time, our biggest mistakes have been not running our winners, and particularly winners with great management teams. So now we've sort of adjusted our process. We're more willing to run winners. So when a company's closer to the intrinsic value we think it's worth, if it's got particularly great management or manager, we'll be more really willing to run those winners. And that's an example of the feedback of our learning process. The businesses we look for. So I, as an analyst, one of the sectors I cover is house builders, and a particular significant holding for us is Barratt Redrow. So to put some meat on the bones as I go through this, I'll use Barratt as an example to discuss these points. So one of the first things we look for is a business with pricing power. So in essence, we want them to be in control of their profitability. A textbook example of this is probably Coca-Cola. You know, if they get an increase in raw materials, they can just they increase the price of their product, and then they can maintain their margin and maybe even grow it a little bit more. But pricing power comes in different forms. Barratt Redrow, their form of pricing power is slightly unusual. The average selling price of their house, they can't really dictate. People don't pay more for a Barratt home versus an equivalent home from another house builder. But where they get pricing power is actually when they purchase land. So when they look at a site to buy, they work out the average sales price, they work out what their build costs on that site are going to be, they decide what gross margin they want to make, and what pops out the bottom is the price they're willing to pay for land. So when we get changes in regulation, like we have currently with environmental standards, that's just priced into the build costs, same gross margin, you reduce what you pay for land. So their pricing power is slightly unusual, and it works with a lag, because if they're buying land today, they're not going to be building on that land for at least 3 years. So it creates a difference between the accounting profits and the cash flow. But that's the pricing power we look at and monitor within house builders. And over the cycle, you can see it works. The second one, probably the most important for us, is high returns on capital. So we pay massive focus to the core capital. So the traditional ROCE metric of a company. So its core, how much capital is employed in it to get a given return. We also put a lot of focus on the marginal return on capital. So you get some great businesses like Diageo that have stunning returns on core capital, but then the marginal returns aren't typically as good because they're paying quite high prices for companies with intangibles and goodwill. So we look at the marginal aspect as well. The opposite of a Diageo example would be a Netflix, where the marginal return on capital is infinite for that business because every new customer they add doesn't require any additional capital for the business. And we really look for those companies, but we monitor both. Using the house builders as an example to illustrate this. So the main capital employed in a house builder is the land and WIP, so the work in progress. And it just in a simplified example, if I'm selling a house for £100, out of that, roughly 25% is going to be the land, and that land we're going to have to hold for 3 years. So it means the capital annualized is 75 for the land. Then the build cost might be 50, and we're going to have that for half a year. So the capital employed there is going to be 25. So we've got a total of 100 capital tied up in building this house. And then the profit we expect to make, gross margins, the residual, so that's the 25%. Maybe we've got 5% admin costs, so the operating profit's 20%. If we then tax that, it's 15%. So we're making a 15% return on 100 of core capital invested. It's a 15% return on capital business. Those numbers are simplified. For house builders, it's actually slightly more attractive than that, but that's how we think about businesses. We want to understand their returns on the core capital to operate their business. Safe capital structures. We never want to lose our investors' capital, so we're super cautious on the corporate capital structure of a business. We do invest in some companies that have some leverage. Weatherspoons would be an example, but that is backed by a significant freehold estate. House builders, as an example, Barratt Redrow, they've got significant core capital, which is land and work in progress. The good thing for them, in a downturn, they sell through that and they generate cash, which they then don't have to reinvest in land. So we really like that capital structure. And they also at the moment have significant cash on their balance sheet. So a very prudently run business. Another one for us is serving a growing market. So our learning is that companies that are operating in declining markets can get desperate and waste a lot of capital. So we don't want to get involved in that, really. So we always want to invest in markets that are structurally growing. House builders. So one of the very few things it seems like everyone agrees on in the UK is that we've got a lack of housing in the country. So that's a great tailwind for house builders. And there's loads of metrics to look at, but one of them is the average number of people per household. In the UK, that's been sort of stuck at 2.3, whereas if you look at other developed countries, it's actually been declining and it's much lower. So it suggests that there's sort of structural, lack of supply in the housing market. As you add more houses to that number should naturally go down. So we really like that tailwind for UK house builders. Another point is transparent. So we want a business that we can understand. And also one that we can get insight to, and I'll touch on that more in a second. A final one is honest, competent, and aligned management. So for us, that's a minimum. We ideally want X factor management who can really make difference, particularly with their capital allocation skills. Michael O'Leary, Mike Ashley, Tim Martin, people in that mould. But at a minimum for us is honest, competent, and aligned management. In the house building sector, David Thomas, we rate extremely highly at Barratt, and we are very risk averse in how we invest in house builders. We think he's got a really good track record. He's been there during the financial crisis, and it's a very well managed and controlled business. And that's something we always look for. The price we pay for companies. So we think of it in terms of intrinsic value. So for every company we invest in, we forecast out the future cash flows we think that business is going to generate, typically for the next 20 years. We then discount that back and get an intrinsic value. People like a simplified world and one number. But that's not the reality for intrinsic values. We've got numbers for each of our companies, which are base case. But they're probably all going to be wrong. Some might be higher in reality, some might be lower. So what we do is use a range. So what's the reasonable best case? What's the reasonable worst case? And what's our base case? So it's a range of outcomes. And then in terms of what we pay, we'll never pay more than half of what we think the base intrinsic value is. So if we think something's worth 100, we'd be willing to pay up to 50 for that. However, if there was a significant variation in our intrinsic value, so if we think the base case was 100, but the downside was 25, we wouldn't pay 50, we'd pay 25. And also we look for companies where there's an asymmetric upside. So maybe base case is 100, we think the downside is 75, but the upside's 200. That's really something we look for, the asymmetry, when we can find it. And our target really is to deliver 15% returns. So that's the discount rate we use when we're looking at companies to invest in. If we can't achieve that price, then we won't invest. So I actually send some of the orders through for our trading. And I can tell you we are unbelievably strict on limits. We have a limit and we stick to it. We don't overpay and we don't push up prices when we trade. Monitoring programs are a fairly unique aspect, I think, of Phoenix and how we operate. So every holding has a monitoring program, and that program is unique to that company. So what we're trying to monitor is what we think are the key drivers of a business's intrinsic value. So you can get lost looking at too much stuff. We try and focus on the core ones. So as a person covering house building, so I quite often am visiting house building sites to see how the sales are done, how the site's managed, whether there's new sites coming online. And some of the other analysts help me with that job. Likewise, Fraser's, our analysts, are regularly visiting their stores to see what's going on. And in particular, we look at sort of the status quo, but also key risks for businesses in our monitoring program. We also create roadmaps for every company. So when we initially invest, we'll do a 10-year roadmap for that company. And what we're trying to do really is put guide rails in for what we expect to happen to that company over the next 10 years. And we'll have a bull case, a base case, and a bear case. And what we're trying to do is avoid drift, because what can happen if a company gradually goes off track, your baseline assumption moves with that over time if it happens slowly. The idea of the roadmap is to stop that happening, because we put clearly in words what we expect to happen when we see a results presentation. And particularly if something maybe is starting to go wrong, we can refer back to the roadmap and say, oh, actually, that's not what we expected to happen. We spend a lot of our time on monitoring programs and looking at companies. And that sounds quite excessive. If you imagine we look at an individual company, then we look at all the competitors we can and the broader competitive environment. It's actually a lot of work to do and things to look at. The monitoring programs and how we operate informs our judgment of companies, and it also pretty fundamentally changes our relationship and engagement with management. So if I was researching an investment in Aurora Investment Trust, I might go to the managers of companies we engage with and invest in, and I imagine they would tell you that we have quite a different relationship and discussion than other managers do. So we care about the long term, the strategy, the businesses are run in the right way for the long term, not the short term. And that might not be usual for a lot of investors. And the monitoring program can entail mystery shopping, internet scraping. So Dan, one of the analysts, has used ChatGPT to create software on a weekly basis to monitor the sales rate of Barratt homes in their developments. I used to spend half a day every month doing that, but Dan's now optimized it and we can do it every week. Business and industry contacts and relationships, news trawling. We speak to current ex-employees, employees of competitors. And what happens in all of those really is the knowledge and compounds over time, and particularly the industry contacts and the relationships, that compounds over time and gets better. So it means that we've been studying for 15 years. For someone else to come now and start looking at that company, it's unbelievably hard to get up to the knowledge base that we've developed over the 15 years of looking at a company, or more in some cases. Strike ratio is sort of like baseball terminology. So for a batsman, every time the ball comes and they swing, how many times do they hit the ball? And it's an interesting thing to think about in terms of investments. And on this graph, we've got two different ways of looking at it. On the left-hand side, it's a binary way. So we invest, do we win or lose on that investment? And we can see that on a total, on that binary measurement, every investment we make, we're likely to make money on 77% of those investments and lose money on 23%. I think that's quite an impressive record, but you also want to think about in monetary terms. So we want to be investing more when we're winning and less when we're losing. And if we do it on those value terms, when we invest £1, 92% of the time, that's going to make money, and only 8% of the time it's going to lose money. And I think if you looked at this over time, it will be getting better over time, over the 25 years of experience we've had in investing. In terms of sizing, and it's linked to that strike ratio point, so it suggests that we're investing more when we're correct in an investment. And really it comes from a version of the Kelly criterion, which means you want to be placing higher bets when the probabilities are in your favor, and the expected return. But our focus probably is more on the probability of winning as opposed to the return element. So that's why it's a version of the Kelly criterion. And what it results in is a concentrated portfolio. So we can invest up to 15% of a cost price weight into a single stock. We would rather do that when we're really confident and have a high probability of being successful. We followed the business for 10 years. We know it really well. We know the ecosystem. We'd much rather invest that in a single stock than we would 1% in 15 stocks that we don't know well and don't have the same level of confidence in. And this is reflected in our portfolio. So we average 15 holdings and we've never had over 20. And the top 5 usually represent 50% of the AUM. And that results in our current portfolio here. So you can see the position and the weighting. So we've got some large positions in Frasers, Castleknoll, Barratt, who I've discussed about. And for example, Frasers, just worth noting, we haven't added to 18.7%. So the cost price weight is well below 15%. It's market appreciation that's got it to that level. And that's an example of us more willing to run our winners when we know a management really well, and trust a business model and a track record. So personally, I cover the house builders, RHI Magnesita, and some of the small holdings. But I'll do my best to answer questions on any of the other of the holdings you might have. And with that, I'd open up to questions.
Thank you very much, Doug. So yeah, there have been a number of questions that have come in. Fascinating presentation. So we'll start with a question here from Alan. I don't know whether you're going to be able to answer this, but I'm going to ask it anyway. Can you share any companies that you're currently conducting research on?
No, sorry, we can't. The only slight carrot I could give you is when we cover a company, we look at all the companies in that industry naturally. And so, for example, so house builders, I would be looking at all the house builders as part of my job. The guys who cover Frasers will be looking at all of that space. So that you can assume we're looking at those companies. The other ones, sadly, I can't tell you about. But I do think generally it's a good environment for us and our style of investing at the moment. So we are looking at plenty of things.
Thank you. So there's another question here from Arthur. It's a slightly political one, given what's happened with the budget recently. But given the focus on the consumer, is the Labour government a major concern for any of your portfolio holdings?
No, I wouldn't say so. I think for the house building positions, they've actually been positive with the ways they've approached the planning system. And I think that did need to happen. And what we've heard so far is they are making good momentum early to resolve issues with planning. And there's a white paper to come, and we hope that will sort of follow through. Other, I guess, political stuff is obviously the increase in the national insurance, and particularly for hospitality businesses. So that's something we're looking at and thinking through, for example, with Wetherspoons, because that's a difficult situation. But the way we invest, particularly with the pricing PowerPoint, we want companies that can control their profitability. So we try and insulate ourselves from those as much as we can. Politically, it's an interesting environment and there's lots going on. So there's lots for us to look and think about.
Thank you. So there's a question here from one, which is playing in and asking about the strategy. And you mentioned there about putting limit orders in. So one asks, how long do you tend to leave a limit order in the market for? And also, will you add to a position after your initial purchase if it moves above that 50% intrinsic value?
That's a really good question. So on limit orders, I don't really refer to us leaving limit orders in the market. It's like an internal limit.
Okay.
So So if we think a company's worth 100 and it's 60, we won't have any order in the market. It's only we would start actively trying to buy once it's at 50. But so we wouldn't leave limit orders out there. I mean, the market is just an internal limit, and if we think something's worth 100 and we test all the assumptions, yeah, it's still worth 100. We're not going to buy it if it's at 51. We will stick to 50. And so and that comes from Gary, really. We're very certain on the price we pay. And sorry, the second part of the second part of the question is a great one, because intrinsic value of a company, our view of that will change over time. So if we think a company, a year ago we thought a company was worth 100 and we buy it at 50, and then the next year it's at 60, but we think the intrinsic value has gone up to 150. We should buy it in theory, but it's actually a really hard thing to do because you anchor to your previous price you've paid and the intrinsic value. So I think that's one of the really difficult nuances about investing, actually, that as an idea. So I can't, to be honest, I can't think of an example when we've done it, if I'm honest. Generally, we're quite unusual in that if we buy a company at 50, we would like it to go down so we could buy more at a certain price. But initially, when we invest with a new company that we don't know particularly well, we stick at a 3% weight, and that's a limit. It's a hard limit for us until we get to know it better. So we wouldn't add a position in that company if it then dropped in price, but we would with a company we know much better. So we're not adverse to difficult circumstances for a business in the short term because it enables us to buy more attractive prices. What we really care about is that business is still generating long-term value, and the best businesses, when they go through difficulty, generate the most future value.
Thank you. So I have a question here about your previous holding in Games Workshop. I believe you did very well, but now you have quite a substantial stake in Hornby. So the question is, what are the main similarities between the two investments, and what are the main differences between those two companies, given that their business models are pretty similar?
Yeah, so I guess I have to be pretty careful here, probably, because Hornby's a separately, listed share, and now it's held within Castleknoll. On Games Workshop, so I mentioned about learning from feedback, and that our biggest mistakes probably are selling shares early, and Games Workshop is a perfect example of that. So we knew the business really well. Our monitoring program, we had guys going out visiting the Games Workshop shops and all the events and everything around it. We understood it really well. We knew the management well. We really respected them. And we sold, and that's been an incredibly painful decision. And the irony of Games Workshop is they pay special dividends, so you get the cash back over time anyway. So you naturally over time reduce your stake in that business. So that's a really painful one. To be honest, I wouldn't feel comfortable commenting on the differences between that and Hornby. So sorry, I'll duck that question.
No problem. And you made an interesting comment there about Games Workshop possibly selling too early, which plays in quite nicely to the next question from Mark, who asks, what is your sell criteria? Mentions there's a change of earnings power, and gives the example of Lloyd's and the car finance potential litigation.
Yeah.
Is that playing into your earnings estimates going forwards? And the main question here is what is the sell criteria?
Yeah, so I think it does vary, and it's another hard one, the sell question. A bit like if intrinsic value goes up, do you pay more? So selling's really difficult. I sort of, in my mind, this is oversimplifying it, have the different types of companies. So there are some companies that you think are worth 100, and if you buy it at 50 and it gets to 95, you've probably sold it by then. You may have got a better idea that's back at 50, but there are other companies that are genuinely great companies, like Games Workshop. There's loads of examples, and you just shouldn't sell. It is the reality, and you should only sell if something changes about your philosophy. So we judge every company on the business, the management, and the price. For some companies, if you get the price, so we grade them A, and we want them all to be A's to invest in. If you've got a superb business, superb management, you can probably be more flexible on the price element. If you don't have those great aspects, once the price is not attractive anymore, you probably look at starting to sell. But generally, my experience of when we sell is if we're no longer confident that the business or management is an A. That's more typical.
Thank you very much, Doug, and that nicely finishes off. Thank you very much for a fascinating presentation. Some great questions there from the audience and some great answers, Doug. Thank you very much.